Welcome back to the channel, everyone. Today, we're diving deep into a stock that has caught our attention due to its incredibly high cost to borrow fees and recent price action. We're talking about CIIT International Inc., ticker symbol CIIT. This is a fascinating look into the mechanics of what makes a stock hard to borrow and the potential for a short squeeze. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's start with a quick profile of CIIT. CIIT International Inc., through its subsidiary Rushing International Company Limited, operates in the industrial sector, specifically integrated freight and logistics. They provide logistics services across several regions, including Hong Kong, Vietnam, Japan, Zimbabwe, and South Korea, offering services like ocean freight forwarding and container shipping. CIIT is a microcap stock with a market capitalization of just $3.06 million and an estimated float of 7.3 million shares. Looking at recent performance, CIIT has seen some significant volatility. Today, the stock is up 3.31%. Over the last 5 days, it's done a slight 0.53%, but zoom out to the last 30 days, and CIIT has surged an astounding 453.10%. Volume-wise, today saw 24,126 shares traded, which is significantly lower than its 30-day average volume of 397,094 shares, putting its relative volume at just 0.1x average. What's cost to borrow and why it matters? So, what does it mean when a stock is hard to borrow? This phrase refers to stocks where the demand from short sellers to borrow shares is very high, or the supply of available shares to lend is very low. When this happens, brokers charge a fee to short sellers, known as the cost to borrow, or CTB. This fee is typically expressed as an annualized percentage. Why does it matter? A high CTB indicates that there's significant conviction among short sellers, or perhaps a very limited supply of shares available in the market to short. When the CTB fee skyrockets, it means it's becoming very expensive to maintain a short position. And yes, these fees can absolutely exceed 100% annualized, sometimes reaching thousands of percent, because it reflects the daily pressure and scarcity. Why this stock is hard to borrow right now? CIIT has landed on our hard to borrow screener with an astonishing annualized cost to borrow fee of 866.8%. Let that sink in, 866.8% just to hold a short position for a year. While the exact number of shares currently available to borrow is unknown to us at this moment, a fee this high is a clear indicator of extreme scarcity or intense demand to short. Coupled with its relatively small estimated float of 7.3 million shares, any significant buying pressure could quickly create a difficult situation for short sellers. Our internal composite squeeze score for CIIT, which factors in CTB, float, volume, and momentum, sits at 52.8 out of 100. It's crucial to remember that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have strong conviction in their bearish thesis and are willing to pay a premium to stay short. Squeeze mechanics explained. So, what is a short squeeze? It's a phenomenon where the price of a stock rapidly increases, forcing short sellers who bet against the stock to buy back shares to limit their losses. This buying action further drives up the price, creating a feedback loop that can lead to explosive gains. Short sellers might be forced to cover if the stock's price rises unexpectedly, if the cost to borrow fees become unsustainable, or if their lender recalls the shares they borrowed. For a stock like CIIT with a small float and a CTB of 866.8%, even moderate buying volume could ignite such a scenario, as short sellers are facing a rapidly increasing cost to maintain their positions. Dilution risk check. One critical factor to consider for any potential short squeeze is dilution risk. Dilution occurs when a company issues new shares, which increases the total number of shares outstanding and can decrease the value of existing shares. For a short squeeze thesis, dilution can be a significant negative, as it can flood the market with new shares, making it easier for short sellers to cover their positions and effectively negating any upward price momentum. In CIIT's case, we found no recent dilutive SEC filings such as SMINUS-1, SMINUS-3, or 424B in the last 90 days. This is a positive sign, as it suggests the company hasn't recently added a new supply of shares that could be used to temper a squeeze. Recent reverse split watch. Another important piece of information for CIIT is its recent reverse stock split. The company executed a 1-for-1 reverse split on July 20th, which was just 21 days ago. A reverse split reduces the number of outstanding shares and proportionally increases the price per share. While this doesn't change the overall value of an investor's holding, it does reduce the numerical float, meaning fewer shares are now available in the market. Historically, it's been observed that many microcap stocks tend to see renewed volatility or a price pop within about a month after a reverse split. This is a pattern seen in some microcap names, not a guarantee, and it should not be the sole basis for an investment decision, but it's an interesting tendency to be aware of. Again, a reminder. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For CIIT, with its 166.8% CTB and small float, there are several things to watch. First, look for any significant increase in trading volume. Today's volume of just 24,126 shares is extremely low compared to its average, so any sustained buying pressure could have a magnified effect. Second, continue to monitor the cost to borrow fee and the supply of shares available to borrow. A further increase in CTB or a shrinking supply would add more pressure on short sellers. Finally, watch for continued price momentum, especially if the stock can break through any key technical resistance levels. CIIT International Inc. CIIT presents a compelling case study for understanding the dynamics of hard-to-borrow stocks. With an eye-watering 866.8% cost to borrow, a small float, and the recent reverse stock split, it certainly fits the profile of a stock where short sellers could face significant pressure. This is a highly volatile microcap name, and as always, perform your own due diligence. If you found this breakdown helpful, please like this video, subscribe to the channel for more deep dives, and let us know your thoughts or questions about CIIT in the comments below.